Natural gas tested new highs but lost momentum and pulled back as traders rushed to take profits off the table after the strong rally. Gas prices experienced a notable rally last week, continuing the upward momentum with a higher opening after the weekend. This movement was fueled by growing expectations of a colder-than-average weather pattern sweeping across the United States from January 2 to January 6. While the current period from December 23 to January 1 is shaping up to be one of the warmest weather patterns in the U.S. over the past 50 years, traders are focused on forecasts hinting at a significant shift to frigid conditions in early January. The heightened sensitivity of natural gas prices to weather forecasts underscores how critical it is for the colder pattern to remain consistent in updated weather models. Should the anticipated cold snap weaken or be delayed, it could spark a wave of profit-taking, potentially reversing some of the recent gains. On the other hand, if the colder trend not only holds but also extends further into January, it would provide strong justification for the ongoing rally, offering additional support for bullish momentum. In this context, traders remain on edge, closely monitoring every shift in weather data as it could heavily influence market sentiment and future price movements. Amid ongoing supply-demand uncertainties, the global gas market is bracing for significant challenges, especially with the impending expiration of the Russia-Ukraine transit agreement early next year. This development could trigger notable price volatility as Europe scrambles to offset the potential loss of approximately 42 million cubic meters of natural gas per day from Russian supplies. To bridge this gap, Europe would need to source roughly 12 additional LNG cargoes per month from the already tight global market. However, I believe this scenario is unlikely, as Slovak Prime Minister Robert Fico recently held direct talks with Russian President Vladimir Putin during an unexpected visit to Moscow. It's reasonable to assume that Fico managed to secure gas supplies for Slovakia through one means or another. If European gas prices fail to experience a significant surge following the anticipated end of Russia-Ukraine transit agreements after December 31, and if this coincides with a shift toward warmer weather forecasts in the United States, we could witness a dramatic decline in natural gas prices on the U.S. market. This scenario has the potential to drive prices downward sharply, likely pushing them to test the critical $3.10 support level. Such a combination of factors, reduced geopolitical risk premiums in Europe and diminished heating demand in the U.S., could trigger a wave of bearish sentiment among traders, amplifying the downward momentum. Notably, natural gas has largely traded above the previous resistance level of $3.65 today, suggesting a potentially significant breakout that could pave the way for further upside movement. However, in the near term, the possibility of a pullback remains on the table, particularly if prices close below $3.65 on the daily chart, which would weaken the breakout's momentum and increase the likelihood of a temporary retracement. In case nat gas settles back below the support at $3.50, it will head towards the next support zone at $3.20 to $3.30. Moreover, the downside correction seems highly probable, as the current price spike appears to be driven by speculative activity. Please like, subscribe, and comment to support the channel. See you in the next one.